Well, thank you for joining us. I'm sorry Adrian Day couldn't make it, but we have here Rick Rule, Tavi Costa from Crescat Capital. We're going to be talking about silver and silver equities today. So a lot of people are disappointed silver prices. We had a large spike up to near 28 or 30 last year, and it's been sideways to down ever since then. Today we're in the 21 range. What do you think, Rick? Is now the time to buy? Is it going lower, or are we bottoming here? What are your initial thoughts on the silver market?
I think the answer to the first two questions is yes and yes. I think it's likely that the silver price goes lower from here personally. My experience has been, in the near term, most asset classes are correlated. There isn't much liquidity in financial markets right now. The financial markets seem to be algorithmically driven, and they seem to be options driven. There's a crisis in confidence, and so my suspicion is that the silver price goes lower. The truth is that my long-term commodity forecasting track record is almost unblemished by success, so the idea that I think it's going lower probably isn't of much consequence to anybody. The second question is now the time to buy? Despite the fact that I think it's going lower, the answer to that is yes. I'd like to own more silver personally, for reasons that we'll discuss later in this discussion. And if I want to own something, the fact that it's going down in price is a lovely circumstance. The silver bullion that I own right now isn't for sale at any price like this. So given that my silver bullion isn't for sale and I'd like to own more, it's in my interest to see the price go down. I realize that makes me different from many other speculators, but you asked me the question about myself, so that's the answer.
And the same question to you, Tavi.
I would say, to me, I think what it comes down to is our views about inflation. I really firmly believe it's the time to be buying tangible assets, and it breaks down into 3 or 4 inflation pillars. You got the wages and salaries growth. You have the supply constraints that are real difficult to reverse those trends over time. It takes a long time. You got the third one, which is fiscal reckless spending. I've never seen a time when we're spending so much fiscal stimulus with unemployment rate where it is and inflation at a 40, 50-year high. I think we're going to learn a lesson here. Back in the 70s and 60s, policymakers are more aware of the implications of spending capital. The fourth one is deglobalization that I've been very focused on, where I think it's extremely inflationary. So if you answer that question of being cyclical or structural, which I think it's a structural change in the macro environment of being more inflationary, I think you want to hedge your portfolio or have positions, the whole crowded 60 and 40 portfolios and how correlations worked in the last 3 decades or so. I think it's about a shift. So when you're seeking those tangible assets, it's incredible to me that silver still is below $30 an ounce. Now, I hear what Rick is saying about the liquidation period. There's a lot of risk in the markets. Just look at market cap to GDP today in equity markets, still 15% above where it was at the peak of the tech bubble. So I call it the great unwind. I mean, we're still seeing a lot of that today. Great example of that. So as folks liquidate, I find it astonishing how silver actually performed very well on a day like today. It should be getting absolutely crushed, along with Apple, along with Google, Amazon, transports. I mean, everything is down 5 to 6%. So I don't know when it's going to turn, but I think as an investor and using value principles, you're supposed to be accumulating assets, like Rick is saying, during times of turmoil. And I think we're there. Do I know when silver is going to turn? I have no idea. But I've been accumulating. We bought 3, 4 more companies in the prior month. We've been adding to our current positions, and we own significant amount of silver.
A lot of people are talking stagflation these days. People are comparing this period of time of low economic growth. We just had negative 1.4% GDP in the United States, high inflation. It's sort of mimicking the late 1970s right now. And during that period of time, gold and silver really launched. Are you expecting that to happen again? And a lot of people wonder, why aren't they at all-time highs right now? Why is gold and silver not at an all-time high right now, Rick?
You're asking me?
Yeah, I'm asking you. Tell us.
I'm sadly the only guy on the panel that was around for the 60s and the 70s. And so sadly, I can speak from experience. This doesn't resemble the late 70s. This resembles the early 70s.
Okay.
1968, 1969, 1970, 1971, 1972. The writing was on the wall for inflation. Anybody could see it. The numbers were published. In our country, we fought the war in Vietnam, we lost. War on drugs, we lost. War on poverty, we lost. We had to pay for all that. Inflation didn't make a difference to people at the beginning of that episode because they hadn't been bitten by it. They'd lived through 2 decades of benign economic climate, 1946 to 1966, 1967. And inflation was an academic topic. After 3 or 4 or 5 years of experiencing it, getting pay raises that didn't keep pace with inflation, having savings deposits where they saved money and they lost purchasing power. It took a long time for people's reaction to the topic to take offense. We haven't been bitten yet by inflation. The broad public lived through the period, as Tavi described, 1982 to 2002, which were the most benign economic circumstances in humankind. And we don't have, as humankind, at present, a realization of the damage that's being done to the purchasing power of our savings by inflation. But if things don't change, and I don't think they will change, although God knows I'm no economist, if they don't change, then you're going to have the situation that you saw in the period 1974 to 1981.
And so, Tavi, you don't have, you obviously were not around back then like Rick, but I know you're a great student of history and economic data. What's your thoughts on that?
No, I agree with him about the early 70s. I struggle finding an analog going back in history when it comes to data. I think what we're seeing is very unique. I call it the trifecta of macro imbalances. In the last 120 years, if you look back, we've seen that to GDP levels like we have today in the 40s. We've seen inflation in other times like the 1910s, the 1940s, and the 1970s. And we've seen speculative environments like the late 90s and the late 20s. Now, have we seen it all at once? The answer is no in the last 120 years. And so it sets up real political constraints when it comes to policy making to tamp down inflationary forces. And so if you go back to inflationary periods, the 1910s, the 40s, and the 1970s, they're all very different, but there are a lot of similarities into those. Rates are deeply negative in real terms. Tangible assets perform much better than financial assets. And the other thing I would say is consider the fact that we are at a much higher valuation when it comes to equity markets. And so I think everybody has seen the commodities to equity ratio chart showing at a 50-year low and other times that we saw that commodities perform very well. Now, how many people are actually implementing and expressing that idea in a portfolio? It's actually very small. Majority of people are still long technology, are still long treasuries and other fixed income assets. And so until we see the unwinding of those crowded positions, I think that that's what creates those dislocations in markets. And so as a portfolio manager, I guess, we've been very focused on finding those opportunities that are very unloved. Silver fits into one of those. Gold does as well, but exploration assets is another one. And it's unleashing a lot of ideas, a lot of macro ideas that I think are going to work very well over the years. Outside of tangible assets too, defensive stocks. You got even the fact that we may see interest rates rising with folks in large institutions having to sell their treasury plays. Emerging markets like Brazil might perform very well. What about China? Now, how does China perform in a place where commodity prices are rising and you have imports rising at the same time as you have issues with deglobalization? So, it's a lot of questions, but I disagree with some macro guys out there that think that this is not an environment to be investing. I think if you have a long-term view, there has never been so many ideas to express your opinions on the markets. And so we've been busy, but and we think there's some really great opportunities out there right now.
A lot of people believe that this is all being driven by the Fed and a lot of other central banks raising rates right now. Is that the main driver right now for gold and silver? And we just have to wait until the Fed pauses and perhaps pivots back to easy money? Is that the trigger that we're all waiting for on gold and silver, Rick? Yeah.
I think there's 3 things. I think people's expectation of the future is set by their experience in the immediate past. And most investors can't spell gold, despite the fact that it's a four-letter word. It hasn't been needed in people's portfolios for 40 years, and the fact that it is needed doesn't matter because they haven't experienced it. A recent study, or not too recent now, by J.P. Morgan Chase suggests that the market share of precious metals and precious metals-related equities in the U.S. is 0.5%, meaning that 0.5% of savings and investment assets in the United States is in precious metals and precious metals equities. That's down from a four-decade mean of 1.5% to 2%. So it isn't like gold and silver have to win the war against the U.S. dollar. They just have to lose less badly. That's the first thing. The second thing is that these things are interest rate sensitive. And the fact that precious metals are doing relatively well in a period of U.S. dollar strength is extremely, extremely important. Precious metals are measured in U.S. dollar terms, and I realize that means they're measured in a floating abstraction, but an important floating abstraction. And if the circumstance that Tavi describes causes the U.S. dollar to weaken, that's significant. Twice in my life, this will be the third time if it holds out, precious metals have done well in U.S. dollar terms when the U.S. dollar was doing well against the rest of the world. And both of those ended up being extremely, extremely buoyant times for precious metals. But a rising interest rate is tough on all asset classes. 1975, in the middle of the 1970 to 1982 bull market, the Fed raised U.S. interest rates. The gold price fell by half. You had all these heroes that watched gold go from $35 to $200. They were committed, long, strong gold bugs. Then the price of gold fell. An asset class that they liked fell in price, became cheaper. Scared, pardon my French, scared the living shit out of them. And these people got shaken out of a trade from $200 down to $100 in time to see the gold price run from $100 to $850. In this circumstance, I think past is prologue.
And Tavi, what's your thought? Is it the Fed that's driving things right now, or are we waiting for the pivot? Are we waiting for easier money before gold and silver launch?
I've been of the view of those political constraints are ultimately what creates the thesis for tangible assets, right? And so I don't know if it's the reversal of tightening policies or yield curve control. You know, we're seeing a record amount of issuances of treasuries out there that I don't think there's enough people covering. About $800 billion has been issued just in the last 3 months. The Fed used to be buying those. They're not buying anymore. In the 70s, all the way to the late 70s actually, nominal rates, 10-year nominal rates are actually rising lockstep with gold. Now, why there is a possibility of that happening, and I don't need to be right about this at all. I mean, I'm very focused on the tangible side rather than treasury as much. But one thing that I think it's going to happen is the shift towards improving quality of international reserves by central banks. So we went through a period where the most credible central banks in the world held up that credibility by buying treasuries. Treasuries are just debt from another indebted economy. And so at what point do we see the shift towards owning a tangible asset that in order to create or restore the credibility or attempt to restore the credibility of those fiat currencies by owning high quality international reserves? And so I think we're going to see a process of that coming back. We've seen this in the past. It's going to create a lot of FX volatility like we saw in the 90s, in my opinion. As interest rates rise, I think we're going to see some sort of volatility in FX markets that I think are not priced in. You know, economies that have their monetary systems that are still fixed relative to the dollar. I think we're going to see some depegs. Back in the 90s, that was absolutely normal. Many countries went through several monetary resets throughout history. We haven't seen a lot of those throughout in the last 2 to 3 decades when it comes to large economies. And so I think we're going to go back to that a little bit. And you know, unfortunately, I think for a lot of market participants that have not lived through inflationary periods, I lived in Brazil. Perhaps it's not a developed economy, and so we don't have the luxury of monetary policy being as independent as it is in the U.S., meaning you know, being capable of printing money to the same degree that we've seen here in the U.S. But one of the things that you find is that how fundamental analysis is extremely important when it comes to investing, and we've forgotten that here in the U.S. And so I think it's going to come back. I think we're going to see cost of capital rising, allowing folks to actually have to do the work, go to earning calls and learn about the companies and read 10Ks and so forth. That's how it used to be back in the days, and it's not like that anymore. So,
you know, there's in the silver market, there's physical silver you can invest in, and then there's the equities. And within the equity spectrum, there's the large producers, the junior producers, all the way down to the explorers, or as Rick likes to call them, the penny dreadfuls. Where are you leaning right now, Rick? What point of the cycle are we in? Where should people be looking?
I don't think there's any one-size-fits-all answer. Understand that although I still like to make lots of money in speculation, I don't need to anymore. I would suggest for most people, if they think the price of silver is going to go up, you start by owning silver. The idea that people think that silver is going to go up and they don't own the physical product is sort of silly. I believe right now, in terms of the equities, that the higher quality equities exhibit better price to value relationships than the small ones do. When I was coming up in my career back in the days, as Tavi suggests, when people actually did securities analysis, that's how I grew up, credit analyst, the low price stocks were usually cheapest because there wasn't good distribution of information around them. Now, in a narrative-oriented world, it seems that the penny dreadfuls, price to value, are overpriced relative to the bigger producers. Now, for an old fat rich guy like me, that's a wonderful circumstance. Capturing the market beta at lower risk rather than chasing alpha that I don't care about anyway is a good circumstance. When, and I say when, in my experience, when the silver market moves, it's like a circus master's whip. The front part of the whip, which moves first, is the metal. The second part of the whip is the big producers. The third part of the whip are the tertiary assets. When they move much further and much faster. But if you are going to start with the end of the whip, you have to be patient enough to endure the first part of the whip's move, and you have to do a lot more work. Tavi and I have been talking about inflation, about printing specious currency. The private sector is more efficient always than the public sector. And the penny dreadfuls can print phony share certificates faster than the US government can print phony dollars. I know that seems hard to believe. So if you are going to participate in that part of the market, you absolutely positively have to do the work. You cannot do this thing, got a hunch, bet a bunch. I mean, you got to go to the booths, you got to talk to these guys, you got to question all their assumptions. It's a wonderful place to me. It's treated me stupidly well. I mean, stupidly well. It's treated me so well that I'm more inclined to capture market beta than chase alpha, unless the sell-off that we're in the midst of today continues, and the alpha is available to me at better prices. Sorry for that long-winded response, but...
And Tavi, you have several different funds at Crescat Capital that have different goals, but just speaking to the overall big picture, where are you leaning? Are you leaning at the large producers, the junior producers, or the explorations? What's your favorite right now? At what point in the cycle are we?
So clarify a little bit. So our global macro fund is where we express everything that we think it's going to happen in the future. And so we hold about 50% metals. This is kind of a range. 50% metals, about 25 to 20% in energy, about 20% in soft commodities, about 5 to 10% uranium. That changes over time, but that's kind of the allocation that we think about things. I think it will depend on inefficiencies and where we find those. We realize, at least in our analysis, that there's lack of participation in exploration assets today. And so you find it's very difficult to navigate the space. It requires a lot of geologic knowledge and as a way to really find those inefficiencies. So today, when you look at the Newmont and VRIC, when it comes to drills, active drills in greenfield regions in different parts of the world, our portfolio today has more drills actually active than both of them combined. And that's the way we think about things, is trying to create value by being bold and exploring in places that we believe that are mineral-rich areas. And so we take a region approach. We try to own as much as we can of the businesses that we like. We have about 85% of our assets in the metal side is mostly on exploration. And this is, we think we're going to enter a age of exploration where most of the majors facing the supply cliff issue will be looking of ways to replenish their reserves. And we think that owning high quality assets with a lot of optionality, with projects that can return value over time and become acquisition targets. I think we're going to go through one of the biggest M&A cycles that we've seen in history, given the fact of all the supply constraints that we have currently. And so that's really the goal, is to be very focused on that niche. We all talk about capital, but it's the labor imbalance. It's the lack of professionals that know how to really exploit those inefficiencies. And I think Quentin Henney, which is one of Crescat's partners, is one of the folks that can perhaps exploit that part of the industry. And so we've been focused working with him.
Well, with that, our time is up. Rick Rule, Tavi Costa from Crescat Capital. I'm Jim Lewis from Wall Street Silver. Thank you very much.